Thanks for tuning in to this week's investment audio cast that we call Cutting Through the Noise. I'm Tony Welch, Chief Investment Officer at Signature FD. So we'll start here with our chart of the week. We've titled this Lower Rates Could Benefit Main Street. So what we're showing here is we're showing financial conditions indices for both Main Street in blue and then the National Financial Conditions Index, which is actually more of a financial conditions for asset markets type index. So you can kind of look at this as Main Street versus Wall Street. And low readings mean that financial conditions are supportive or easy. Higher readings in these indices mean that financial conditions are tighter. And here you can see a pretty big dispersion here between financial conditions for Main Street versus financial conditions for Wall Street. And that's precisely why we're looking for a Fed interest rate cut here in September, so long as the inflation data cooperates. And we'll get into that a little bit more here in a second. But lower rates could have the impact of benefiting Main Street. So that is something to watch. We'd like to see those conditions ease up to kind of arrest the slowdown that we've seen in economic growth. So with that said, looking at returns year to date so far, it's been a solid year for most asset classes. So large cap US stocks are up a little over 11%, small cap US stocks up a little over 8%. International markets have still been leadership on the year. Developed international up almost 24%, and emerging international up 21%. And we can see here that a lot of that is owing to a weak dollar. Not all of it, but the dollar has dropped almost 10% this year, and that's been a tailwind to the international markets. Now, when we look at the economic data from last week, it's clear that the labor markets are still continuing to ease here. So what we're showing here in these two clips is the monthly change in non-farm payrolls. And the bottom is private non-farm payrolls, just a little bit of a different calculation. But the economy only printed 22,000 jobs here in August. That is a very low reading since the pandemic. And with revisions, it's actually showing that jobs contracted in June, not by a lot, but a little bit of a contraction in June. So the trend has definitely been downward. Now, something that's coming into play here is immigration policy. Immigration policy is likely having an effect where not as many jobs need to be created here to support the labor force. But still, this slowdown in job growth is something that's notable. And because we have other things that are impacting the job creation, we want to watch some other data like the unemployment rate, which should normalize the shrinking in the labor force. And what we can see here is really over the last couple years, the unemployment rate has very slowly but steadily inched higher. And we can see the monthly point change in the middle clip. And you can see these last 2 months, the unemployment rate did tick up notably for 2 consecutive months. And now it's sitting a little over 4.3%, which is about the highest that we've seen since this cycle began after the pandemic. So the unemployment rate rising, that is confirming that the labor market is slowing. Now, what we're seeing from a corporate perspective and for earnings and margins is that productivity is really helping to mute any sort of inflation impulse. So what we see here in red is we see non-farm unit labor costs, and that tends to be the biggest expenditure for companies is direct labor. And we can see that unit labor costs have been easing on a year-over-year basis here for about the last year or two. And productivity trends are really a big driver of this. So this AI boom and spend on technology, that is helping companies to be more productive with their workers, helping to keep unit labor costs down. And in turn, that should put some downward pressure on inflation. And that's what that blue line is showing, is that's just showing core inflation, and it tends to track pretty well with what we see in unit labor costs. So this productivity surge, that has certainly been a positive from an economic perspective and for corporate earnings. And we can see that particularly in corporate profit margins. So what we're showing here is, again, we're showing unit labor costs in that dashed black line, but we're showing corporate profit margins in blue. And there's at least a mild negative correlation between these two series. So as unit labor costs are coming down, typically corporate margins, profit margins are expanding. And we can see that here, that profit margins have been incredibly robust here in the last couple years and have remained so despite any sort of inflationary impulse or the tariffs. So certainly productivity trends, lower unit labor costs, those are helping to support corporate earnings, which has been positive for the bull market and the sustainability of the bull market. So we think the Fed is likely to cut here in September, and that would be the first cut after a pretty long pause. And here what we're doing, we're showing a chart that shows the S&P 500 around that first cut following a 6-month or more pause in rate cutting cycle. And you can see here that on average, the market tends to perform pretty well after the Fed re-engages in a rate cutting cycle. So we think that that could be the case this time around and could continue to be supportive of the bull market. And again, market breadth is acting like the market is expecting a cut and it's going to be positive for risk assets. So what we're showing here, that orange line in the bottom clip, that's an index that our friends at Ned Davis Research put together that measures the percentage of sub-industries that are in uptrend. So very simple. It's how many sub-industries in the US market are trending higher versus trending lower. And historically, when that gets to very elevated readings like it had towards the end of July, the next 12 months have tended to be quite strong for the markets. You've had median returns of about 17%. And in 20 of 20 cases thus far, the market has been up 12 months later. So that goes in line very well with what has tended to happen around that first rate cut after an extended pause. So this is another good sign for the markets. So our closing thoughts for this week is Wall Street financial conditions, they've been much easier than Main Street financial conditions. And a lot of that has to do with what's going on in housing and mortgage rates. So therefore, lower rates, and again, a Fed interest rate cut doesn't guarantee lower mortgage rates, but it could help. And it could help narrow the gap here between Main Street financial conditions and Wall Street financial conditions. Now, so far in 2025, returns have been strong, and we've seen particularly leadership from international markets. Now, the prospect of a Fed rate cut, that's potentially adding a tailwind to that international trend because it has the tendency of softening the dollar if currency investors are expecting lower rates here in the US. And so that's adding a tailwind to international stocks. Now, the job market continues to soften. That much is pretty clear. Immigration policy is certainly playing a role. So we do want to discount non-farm payroll growth just a little bit. It's important, but we do want to discount it a bit with all the noise coming from immigration policy. But what we want to watch is things like the unemployment rate, which try to normalize the labor market. And that has been slowly inching higher as well. So that really just confirms that it is a softening labor market. That should support a Fed interest rate cut here and probably the start of a normalization cycle. So more cuts to come. There's inflation reports later on this week, and they're going to be important to watch for Fed policy. But a resumption of that rate cutting cycle, that could support the continuation of the bull market. And market breadth suggests that that historical pattern for Fed cuts following a pause is more likely to hold, and we'll have some similar market action to what we've seen around those situations before. So that's what we have for you today. As always, I want to thank you for joining us and wish a great week ahead.